What a week. What a week. It's only Thursday. Let's start with oil prices, shall we? As we look at what's going on with Brent crude, West Texas Intermediate, natural gas, Red Sea, Israel, Gaza, the Middle East. Oh, it's all happening. West Texas Intermediate, 81.15. Brent crude, 85.92. So Brent is slowly climbing to 86, but coming down from those highs. Natural gas, $1.62. What about exchange rates, fiat currency, the dollar against the basket of currencies? $1.09 gets you a euro. Dollar, well, no, that pound can't be that. So unfortunately, that's been transposed. So 151 is actually the yen. There's no way the dollar would trade at 151 to the pound. So apologies for that. So that should be the end. Let's go to cryptocurrencies. 67,000 for Bitcoin, $151 to the pound. The world would crack. Ethereum at 3,563. Asian markets. Let's take a look at the Asian markets. You live by the graphics, you die by the graphics, ladies and gentlemen. The Shanghai Composite Index down, but the rest of the markets, Hong Kong, Kospi, Nikkei 225, best performing index in Asia. They're all on the up and up. Europe opening in bullish territory. Pan-European stock index up about 88 basis points. FTSE 100, they're primed and waiting to hear from Andrew Bailey later on. We'll see how the pound performs. DAX, where inflation is decelerating. Also, PMI numbers coming in for Germany and France. Markets responding positively. All right, let's listen to Christine Lagarde, who is still very data dependent in her speech.
We will have a new set of projections that will confirm whether the inflation path we foresaw in our March forecast remains valid. These projections will also implicitly give us more insight into the path of underlying inflation. We will have more visibility on the strength of the recovery and the likely direction of the labour market, and therefore on the consequences on wages, on profit, and on productivity. In addition, we will have had a longer window to assess whether inflation data continue to fall broadly in line with our projections. If they do, we can be more confident that our models are now more accurately capturing inflation dynamics. And this confirmation will be particularly important for the more persistent components, such as services, so that we can trust that these components will continue to decline in keeping with their typical lagging pattern. If these data reveal a sufficient degree of alignment between the path of underlying inflation and our projection, and assuming, of course, that transmission remains strong, we will be able to move into the dialing back phase of our policy cycle and begin making policy less restrictive. But thereafter, domestic price pressures will still be visible. We expect services inflation, for example, to remain elevated for most of this year. So there will be a period ahead where we need to confirm on an ongoing basis that the incoming data supports our inflation outlook.
All right, let's get to Jerome Powell, of course, also, at his press conference, along the same lines, talking about inflation being the main target. Here he is after the Fed held rates.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance.
All right, what is the play based on what we've seen so far? We're happy to have Laura Fisayo-Kolawole, who's the head Equities and Alternate Asset Solutions at FBNQuest Asset Management with us today. Laura, good morning to you. Thank you so much for joining us.
Good morning. Thank you for having me.
Did you have the hold in your forecast as well? How do you see what we saw from Jerome Powell?
I think us and the rest of the world had a hold. To be honest, I think 99% of analysts were expecting a hold. So Powell has been very good at controlling the rhetoric and really carrying markets along. Earlier in March, he had talked about the fact that the Fed was not far from feeling confident that inflation was declining to 2%. So there was really no surprise here. I think all the talk now is really around, one, the timing of those cuts, but also the magnitude and how quickly he will cut. Again, the Fed has also been very clear that they will cut 75 basis points this year in 2024 and keep cutting into the next 2 years. So the market has really read the body language of the Fed as relatively dovish because they maintain 75 basis points being the cut for this year, despite not cutting now. I think markets now expect the Fed to cut from about June going forward.
Yeah. All right, great. So you guys, by the way, I get your FBNQuest newsletter. I read all your reports. You guys are doing great work. You cover all over Africa and everywhere else, even the globe, right? So what is the equity market play based on what you just said now?
So overwhelmingly, we spend a lot of time trying to understand global investor sentiment, investment flows, and overwhelmingly the view is developed market equities over EM equities today. Developed market equities, primarily the major countries, US, the major ones in Asia like Japan, for example. You talked about Japanese markets doing extremely well recently. That really is the play, and they're all driven by US growth and the fact that US growth has remained extremely resilient. So we see US markets, they're up sort of 5 to 9% on a year-to-date basis. The Nikkei is up 22%. It's really flying. Markets in Korea doing really well as well. And that is really driven by US growth and the fact that the Fed is seen as quite dovish, expecting to start cutting rates from now on. When we look at emerging market flows, so on the developed market side, for example, looking at flows into developed market funds, we've seen the highest flows since March 2021 over the last few weeks. Emerging market equities, I think, are taking more of a wait-and-see approach. Investors probably want to see the Fed start cutting before they start rotating. Even in our local market in Nigeria here, yes, you may argue that devaluation has created value in Naira assets, but we're really fighting against inflation. We're fighting against really a changing regulatory landscape. Disposable income is a problem. So I think foreign investors coming into Nigerian equities, quite selective, perhaps a lot more interesting to fixed income, for example.
Okay, well, thanks. You've preempted my next question. So if those cuts do happen, do you see that rotation? Because you've seen the last Treasury bill auction. I mean, we're waiting to see what happens with the MPC next week. Does that not mean fixed income and money markets are benefit more than the equity markets here, if that happens?
I mean, we think so. So a dovish Fed really does favor that carry trade. It really does favor people, the investors searching for yield. Now, locally, we estimate that we've seen something like over $2 billion of flows into Nigeria in the last month and a half. Since we had the rate cut, we had the devaluation. Yes, there's a lot of debate as to whether we'll see further cuts next week. But to be honest, there's been some success in the cuts that we've seen so far. But even when we look further afield, if we think of Egypt, I think that has really been the star of flows in Africa. I mean, Egypt has probably attracted something like $40 to $50 billion worth of flows from, we have sources like the IMF, the World Bank, the EU, UAE, you know, into their real estate market, but also just brought investment into the country. And they've done a few things. They've also devalued the currency. They've raised rates by 600 basis points. And they've sold their one-year T-bill at over 30% yield.
Oh, that's delicious.
Exactly. And we've seen similar flows as well into other Eurobonds that have been issued by the likes of Ivory Coast, Kenya, Benin Republic this year, where about $5 billion has gone into those bonds as well. So there's a lot of demand for Africa risk. We see that those Eurobond issuances are always really oversubscribed. So we think that trend will continue, definitely.
Oh, we heard from Christine Lagarde. She's, being very cautious. How do you see, I guess, what's going on over in the EU and Europe? What are they looking like?
I think Lagarde has been extremely cautious in trying to control both inflation and inflation expectations. You know, Europe has seen inflation come down. I think the last numbers for February, 2.6% inflation. So they're actually closer to their inflation 2% target than even the Fed, for example. But yet she's really remained quite data-driven. She's always talked about the fact that she doesn't think they've seen consistent data that allows them to be confident that inflation is declining sustainably. And she's really waiting for that data. She's really planning to go meeting to meeting. And so with Europe, the main concern is, yes, inflation is declining, but we're seeing wage pressures. We're seeing wages actually go up, which means that there's underlying tightness in the labor market. And that's what they're trying to fight against with keeping policy quite tight. In addition, I think everybody's Fed watching. Yeah. If I'm being really honest, I think the ECB will not want to move before the Fed. I don't think anybody wants to move before the Fed. Because if they move before the Fed, what that likely means is euro weakness, which again stokes inflation pressures. So ultimately, one, I think they will not move before the Fed, so they'll probably wait until the Fed has moved. But secondly, they've been very, very cautious in saying it's data dependent. So we don't think there'll be a hold. We don't think there'll be a hike. Or cut or anything next month, likely to just stay the same next month and perhaps move later in the year. All
right, Andrew Bailey is up next. We're going to hear from him later. I mean, how do you think, without getting into whether they hold or whatever it is they're going to do, how is the UK now as an investment destination? When you look at the UK, what do you see?
I think the UK is it's a bit different, a bit in a difficult situation. So they're likely to hold. I mean, I know you said we should, but they're likely to hold, right? But with the UK, it's a bit more unfortunate because they have slipped into a recession. So they officially went into a recession in Q4. So that's one thing the Bank of England is fighting against. The second thing is that inflation is declining. So thankfully, I think 3.4% was the last reading in February from 4%. So they are seeing that decline, but the Bank of England, again, is still talking about the fact that it sees a tight domestic demand market and it's seeing wage pressures. So even though inflation is declining and even though growth is clearly quite weak, they're being very cautious. And I think that we're seeing that in the risk assets in the UK. So for example, if you look across the major markets, I talked about the Nikkei being up like 22%. I talked about US markets 5 to 9, almost 10%, and touching record highs after the Fed yesterday. But in the UK, the market's up like 1.5%. You know, very, very sluggish growth this year, the FTSE 100. And that really just highlights the tough investment environment that we have in the UK. And we expect that's likely to continue just because of where growth is and the fact that the Bank of England is still going to keep conditions quite tight despite falling growth. So difficult environment, I think, in the UK.
I wish you had more time because I could listen to you analyze global markets for the rest of this show. Laura Fisayo-Kolawole, the head of Equities and Alternate Asset Solutions at the very awesome FBNQuest Asset Management. Thank you so much for your time. Really appreciate it.
Thank you so much. Thank you.